Okay, before we take the market chatter forward, let's quickly pull up the buy now, sell now stock cloud as well to give our viewers a quick update on all the individual stocks to keep on their watch list, starting with Nifty heavyweight BPCL, the stock sulking away in trade. They've announced paying a second interim dividend of about 5 rupees a piece, and the street clearly isn't happy about the figure that they have finally zeroed down on. SBI Cards, another name to watch out for, and another name that is looking quite weak as we speak. Carlyle Arm is looking to sell 4% in the company. The sale price has been fixed in the range of 981.8 to 1022.1 rupees a piece. Next up, you also have another heavyweight that's looking a bit weak right now as we speak. Vedanta Resources has revised voluntary open offer for the company. The promoter has hiked the open offer price by 47% from 160 rupees earlier to 235 rupees. Then you have Dalmia Bharat, which is flying in trade. The Supreme Court restores mutual fund units worth 344 crore rupees in the company's account. CLSA has meanwhile upgraded the stock to a buy and raised target from 1650 to 1900 rupees a piece. Next up is IDBI Bank. We spoke exclusively with the management earlier today. They're expecting retail portfolio to grow in the range of 10 to 12%, seeing improvement in cash flows in MSME as well. Godrej Properties, another name to keep on your radar. They've raised about 3750 crore rupees at 1450 per share through their QIP. BEML has received export orders from Cameroon and Bangladesh for supplying construction equipment valued at close to $23 million. CG Consumer, another stock to watch out for. Jefferies has come out with a detailed note maintaining a buy rating, target at 490 rupees. Sumitomo Chemicals, Sher Khan has initiated with a buy, target at 350 rupees. Time Technoplast, another name to watch out for. They've been declared as the lowest bidder by NHAI for an order worth 770 crore rupees. There you have it, list of top 10 names to keep on your radar at the top of this hour.
All right, so let's take that forward a bit and get you the high risk and low risk ideas. We're joined today by Kunal Bothra as well as Shahina Mukaddam. We'll first go over to Kunal. Kunal, good morning to you. What are your high risk and low risk ideas for our viewers today?
So good morning, Alex. Good morning, everyone. Two buy calls which I would suggest at this hour. I understand the markets are a bit choppy, so I think adhering to discipline and trading stop loss is the key in this kind of a market. So I would advise a couple of trades. One from the high risk category, it's a buy on BEML. The stock is showing signs of a breakout yet again on the daily as well as on the hourly time frame specifically. On the hourly charts, it's confirming a breakout of a falling trendline resistance, which I believe could probably lead to a short-term upside on the stock price. So I would suggest a buy, more of a high risk trade. Targets to be kept at 1500 for BEML. Stoppers could be kept at 1360 mark. The second is from the low risk category. It's a buy on ITC. Now, in fact, just some time back, I did a chart buster segment on ITC, indicating that how the stock has been taking some very strong support around the 200 mark. And every time we've seen that the stock has bounced off from those 200 levels, it's resulted into a credible bounce for the stock price. So I would expect ITC to hold up, even from current levels, the zone of 200. And if this happens, then there could be a resumption of a rally for the stock over the medium term. So a positional buy on ITC, targets of 240, stoppers at 200.
Well, absolutely, Kunal. In fact, ITC among the top performers on the Nifty today, up about 1% as we speak. Let's go across to Shahina as well. Good morning to you, Shahina. What are your picks today for our viewers?
Good morning. The two picks I have for today are Ambuja Cements and Greaves Cotton. I'm pretty positive on the overall cement sector. Cement prices have been rising, and in fact, just yesterday, for the Western region, cement companies have taken another 10 rupee price increase. So if you see Ambuja Cements, last quarter, they did a 12% overall revenue growth, of which 5%, almost 4.6% came from price increase. So I think on a YOY basis, this sort of increase is likely to continue on into the current year. And also in volumes, the increase in volumes from infrastructure spend is actually showing up very well on the volume growth of cement companies. And with the new capacity in Rajasthan coming up, I think Ambuja Cements should do pretty well in the year going forward. So I have a price target of 340 with a stop loss of 240. The next one is Greaves Cotton. The company has actually established itself in engines, diesel and petrol. And going forward, the thrust of the government on EV engines and EV two-wheelers, I think will play out very well for the company. It's got good investments in this space, very strong balance sheet. So here I have got a target price of 170 with a stop loss of 115.
Okay, all right. Request you both to stay on with us. We're slipping into a break, and on the other side, we'll touch base with our viewers' query. But before we do that, here's a quick programming reminder. The India Economic Conclave has always set the stage for driving India's economic agenda. We're back again to focus on India's outlook and vision for the new decade and its aspirations for a new India. Our theme this year, India's decade to reform, perform and transform, will feature biggest voices from politics, global markets, economy and the corporate world. Catch all the action right here on Times Network.
Welcome back. You're watching Buy Now, Sell Now. Let's delve a little deeper into some of those stocks that are making news. And let's start with SBI Cards. We mentioned that in the Buy Now, Sell Now cloud. This is a stock that is down about 3% in trade. And that's perhaps because a large chunk of the company's shares are exchanging hands. Vinny Motiwala is joining in to tell you all those details. Vinny, what are you picking up?
Carlyle's arm is to sell 4% stake in SBI Cards and get an almost 970% return on its investment in the last 4 years. So the US private equity fund, that is CA Rural Holding, which is an affiliate of Carlyle Asia Partners, will be selling this 4% stake. Previously, as on, if you look at it, as on 31st December 2020, CA Rural Holdings held around 15.86% stake in the company. Suppose they sell, the PE fund will still hold 11% stake after even selling this 4%. Now they are looking to sell this for a stake worth is around $514 million, or you could say 3,728 rupees through a block deal today. Now SBI Cards investment would be the best exit actually by a PE fund in the Indian investment, and the sale price for this is fixed at 981.8 rupees to 1,022 rupees per piece. So an interesting block deal which we could be expecting to see today in SBI Cards, and let's keep an eye out on that, because a very good return coming in for the Carlyle arm. 970% return in 4 years is very, very good, and surely we'll keep focus on SBI Cards as well.
Thanks, Vinny, for that. Meanwhile, Vedanta Resources has revised its open offer price for its listed entity here, Vedanta Limited. The promoter has also expanded the size of the open offer. Mubina Kapasi joins us for everything that you need to know about this development. Mubina.
Well, we at ET Now had told you back in Feb that Mr. Anil Agarwal's Vedanta Resources Group is looking to pick up a higher stake in Vedanta Limited, and now it's official. The promoter group of Vedanta Limited has revised the voluntary open offer that it had launched back in Jan 2021. Earlier, the offer was to pick up a 10% stake at a price point of 160 rupees per share, and now the size as well as the offer price has been expanded. So the size has been expanded from 10% to 17.5%, but it's the offer price really that has seen a bigger increase, of course, to the benefit of the shareholders. That one has surged from 160 rupees to 235 rupees. Now, of course, I think this was seen as coming because since January as well, metal stocks have seen a massive surge, Vedanta being one of them. Currently, the share price of Vedanta is at roughly about 226 rupees as per the last closing market price. So I suppose this had to come about, especially if Anil Agarwal does want this voluntary open offer to go through. By the way, the offer opens on the 23rd of March. That's roughly 8 days from now, and will be closing on the 7th of April. How the share price moves will of course determine as well whether shareholders would want to go for the open offer or do they find a better value in the market price. But if the entire open offer is subscribed to, the promoter group's shareholding will then jump to 72.6%.
All right, Vedanta relatively unchanged in trade. Thanks, Mubina, for that update on the open offer. Let's move on now and get you a conversation that we'd had earlier with market veteran Sandeep Tandon, and he shared his secret sauce to success and how to get rich. He recommends to build a diversified portfolio and remains bullish on the agri and commodity space. Listen in.
Going forward, this is the time to build a portfolio which is broadly quite diversified as compared to skewed portfolio. In last many years, skewed portfolio has delivered extraordinary returns, okay, for various reasons, okay. Going forward, when market is in the process of discovering new names, so it's a strategy that you should have a well diversified portfolio. You should have more of a value stocks in your portfolio. You can also have a lot of commodity, despite a move of commodity stock, which we have seen in the past, but they remain buy on dip as a strategy because we believe commodity cycle is on the up move. And anything related to more from the agriculture space, I'm very constructive and very positive for maybe for a decade story, which is already unfolding in the agri space. So these are the spaces which you should identify, and anything related to capex cycle, if you get it at right valuation and it is under owned and which has delivered in the past, those are the stocks you have to identify.
Meanwhile, it's raining IPOs on D Street, and we are touching base with one such management that has hit. The stock of whose company is all set to make a debut on D Street. Nazara Technologies, we're joined by Nitish Mittersen, the joint MD, and Manish Agarwal, the CEO. Good morning, gentlemen, and welcome aboard. Nitish, I'll start the conversation with you, and I'd like to understand what kind of response did you expect for the IPO? What is the outlook on the monthly active users as well? From an average of about 40.17 million, what is it that you expect?
Sure. Avan, we're of course, very happy. It's a milestone day for us at Nazara. We've been at it for 21 years, and it's a very exciting day for us. And we have the love and affection of all our partners, all our team, all our investors, and hopefully of all the shareholders who will be joining us soon. We believe the dream we had of India being a large gaming country is more closer, and we believe that the next decade is going to be the decade of gaming for India. So we're really looking forward to this and very excited about it.
Manish, I'd like to get in a view on the same from you as well. How was the response to the IPO and the outlook on MAUs?
Yeah, I think unfortunately we are not in a position to give you any forward-looking statements, as you will appreciate. All I can say is that we have built a very strong platform for us to continue our growth momentum of past, and we do whatever it takes for us to leverage the great opportunity which Nitish mentioned about the golden decade of gaming, and to leverage that. And we have the best A team which can make it happen.
All right, Manish, coming to you on this one, what further acceleration that you see in demand over the course of 2020 and going forward as well? How do you see that panning out on account of the COVID-19 situation for EdTech and for esports as well as mobile gaming?
So if you see, our strategy of following three massive consumer trends was laid out in around 2016-17, and we have been doggedly persisting with those thought processes and building up a springboard. They are that gaming is going to be the biggest pie of the entertainment because it's zero friction on players to really consume and interact with the gaming content. Second, sports entertainment will be really, or let me kind of put it this way, gamers will be watching professional gamers playing video games, and that will take a large share of sports entertainment business in terms of viewership, media rights revenue, and brand sponsorship. And third, learning can be made fun through gaming, especially 2 to 6 year old child when they are foundation days and you want to not saddle them with too much of pressure on outcome oriented pedagogy. So I think those are the three consumer trends which we have kind of looked at and we have been doing about it. And events like COVID solidify those habits, make it more tangible and more deep-rooted, which further strengthens the opportunity which lies for a company like Nazara in front of it.
All right, got that. Nitish, coming to you on this one, the company's stated objective has been to build its market position and also continue its global expansion. What are the plans there, and what capex have you set aside?
I think, we will build on our Friends of Nazara network. We have partnered with some great companies, some great founders, some great teams. And the platform that we have created, the Friends of Nazara, what we like to call, is very scalable. And we would love to add more friends to our platform going forward post the IPO. We will, of course, be on the lookout for, companies that fit and businesses that fit our strategy and our DNA. And as and when the right opportunity arises, we will be more than happy to go ahead with it.
Manish, Nazara plans to continue pursuing strategic investment as well as acquisition opportunities. Now, what has been lined up on the acquisition front? If you could give us some color on that, and where is it that you're looking to increase stakes? Which verticals would you or could you be focusing on going forward?
The current verticals that we are working in are which are our strong growth drivers: the esports space, the sports simulation space, the gamified early learning space. I think these are all very exciting spaces where our teams are doing a lot of work, and there's huge potential for growth into the future. And we will continue to invest in these verticals. There are several other areas and extensions, adjacencies that we are interested in. But it's very important that we take the right calls. We do not hurry into it. So I think we will be very selective, very careful in terms of where we put our not only our capital, but also our bandwidth into to ensure that whatever we do is creating value for ourselves and for our shareholders.
Historically, Manish, the company has been EBITDA positive and has generated sufficient cash flows from operations. If you could tell us what is the outlook on your cash and cash equivalents, and what about the worries of negative cash flow? Could you clarify on that as well?
If you look at it from our perspective, we as a DNA believe in running businesses, growing businesses with a very skewed focus and single mind focus on ensuring that our EBITDA margins are positive. We do not stop at EBITDA margins. We also look at our cash flows and look at how our cash flows are positive. And we are always looking at how can we, from operationals, we can generate enough cash which can bring back, we can plow it back into investment. So as a company, we have a long decade, a track record of being EBITDA positive. And also, if you look at in last 2 years, you would see from your financial numbers that EBITDA margins are increasing, EBITDA absolute numbers are increasing. And if you see a PBT which is negative, it's predominantly because of depreciation and amortization expenses, which are non-cash items. That is coming on account of increase of intangibles in our balance sheet owing to acquisitions. That is why you see a negative in terms of PAT. Otherwise, from a cash point of view, it's a positive cash flow and it is a positive EBITDA business. And these acquisitions have done exceedingly well. They've grown very well. And for us, that's the growth platform which we are really building. And the business, right way to look at our business is to look at EBITDA margin expansion, and the revenue growth and the absolute revenue. I think that's the right way to look at our business.
All right, Nitish and Manish, great chatting with you. Thank you so much for joining us this morning and talking in detail about the company's plans going forward as well. Slipping into a break once again, and once again giving you a quick reminder about the India Economic Conclave. We've always set the stage for driving India's economic agenda, and we're back again to focus on India's outlook and vision for the new decade and its aspirations for a new India. Our theme this year, India's decade: reform, perform and transform, will feature the biggest voices from policy, global markets, economy and the corporate world. Catch all the action right here on Times Network.
All right, we're back on Buy Now, Sell Now. Thanks so much for tuning in. We'll head straight to the queries that have been sent in by our viewers. And in fact, we'll start with the first one from Jay Doshi, who's written in asking about Trident. He's bought at 14.5 per share. And it's a simple question: should he sell or should he hold on? It's a narrow gain that he's making at this point, Kunal. What's the advice that you would have for him?
I think we should book out profits over here. These are very, very high beta stocks. Trident, I think in the last 9 months, 12 months have done exceptionally well for itself, from being down to almost 4 rupees or below that. It's recovered quite well to almost 3x, 3.5x from those kind of levels. But when you try and compare the charts from a longer term perspective as well, it seems that the stock is coming back into an overbought territory. So, an idea of buying a mid-cap name, augurs very well when the mid-cap stock in that purview remains to be at a lower levels. But the stock has done exceptionally well as it is in the last 8-9 months. So buying the stock at a higher levels and expecting the stock to keep on performing even if the market remains a bit choppy or sideways could be too much to ask for. So which is why I would be of the belief that it's prudent enough to try and take out profits over here. Wait for stronger bouts of corrections into these names. So assuming if the stock gives you a correction till say levels of 12 or below that, that could be a good starting point for you to enter back again on Trident. And I think then from there on, the chance of you making much higher rewards are far more higher.
Right, fair enough. The buy price is key to bear in mind here. I'm going to come to you on this one, Shahina. So the advice on the technical front is to book out profits and wait for dips. But on the fundamentals, there is a view that says that the paper business could do well going forward once restrictions are lifted, once people go back to work and school, etc. Is that something that you would consider as a lifting force for something like a Trident?
Yes, I think Trident, in my view, one can hold at current levels because there's a lot happening on both the segments. The paper segment, as you mentioned, there is seeing an increase in demand. They have set up new capacity. The capacity in the craft paper is also likely to, increase the volume sales going forward. Also, in terms of their textile division, they recently got a patent in Europe. And there also, I think, there is a good turnaround that's happening in the overall textile segment going forward. Prices are strong. I believe this is more like a turnaround stock for FY23. If they are able to do more than a 1 rupee of EPS, which I think they will be able to do, then I think this price can go up still more from here despite the very strong performance. So I would continue holding at current levels and review it at maybe 15 to 20% higher levels.
Okay, moving on to query number 2, which is also an email. Kapil Singh writes to us from Delhi. He's bought 2,000 shares of Ashok Leyland at a price point of 86 rupees a piece and wants to know whether it's a good level right now to book profits and exit, or should he continue to stay put. Time horizon is not mentioned, unfortunately. Kunal, he's already made a decent amount of money on this one. What would be your advice at this juncture?
So I think it's a good enough decision to try and book out at least partial profits, if not more, on Ashok Leyland. Now the auto stocks have done phenomenally well. It's bound to be that after doing, or after multiplying from I think 45 rupees or 50 rupees odd to levels of 120, it's bound to be that the stock goes through either a correction or either a time-wise correction or a price-wise correction. Look at the charts for Ashok Leyland. The last 2 months, the stock has gone through a time-wise correction. So it's a probability that the stock can come back to levels of even 100, 105, where it could find some credible support going by. So I would advise that book out at least partial profits, and then if the stock comes back to a level of say 100, 105, look to purchase it back again. I think that could be a much prudent strategy. Your buy price, net buy price, would of course get much more on the lower side, and you can probably take advantage of any kind of correction as well. So I would advise a partial profit booking over here, and to re-enter if the stock comes back into the zone of 100 to 105.
Okay, so booking partial profit seems like a proven bet to Kunal. What is your view on this one? Coming to you, Shahina. Ashok Leyland, now that the CV cycle is finally turning up, should our viewer here book profits and exit, or should he stay put? Perhaps over the next few months or a year or so, it could give him further gains.
If he's a longer term investor, I see this as a good investment portfolio stock for now, because the CV cycle is turning around for the positive. And as we hear the management say, even the LCVs are doing very well for them. The new scrappage policy is going to be another positive trigger for Ashok Leyland. So, I mean, if I'm not looking to trade, I would probably hold it for the medium to longer term. I see a good price target of about 150 if you're holding it for a year. So it will depend on the time horizon of the investor.
Good point there, Shaina. And in fact, I do want to point out that we spoke to the management of Ashok Leyland, and we asked them about the outlook for the company, how the CV cycle is panning out. We spoke to, in fact, Nitin Seth, who is a COO of the company, and here's what he had to say.
I think margin is one subject we don't give a guidance on. But one thing which happens in a margin scenario, I think all of you should be aware, the commodity prices is increasing day by day. Margins for all auto companies will be under pressure because you can't keep passing on the price hikes in the market. So as a guidance, we don't provide. But the only thing I can say, margins will be pressure for all automobile companies going forward due to commodity price increase.
Right, so margin pressures are set to continue. Let's stick with the auto space then, because the next query we have is from Manoj, who is written in from Delhi, and he's holding Maruti at a level of 7,650. He's asking whether he should hold or exit. Again, he's not given in a time horizon for his holding, Kunal. And actually, I would encourage viewers to tell us what their projected time horizon is, because that will help give you a better answer. But assuming that it is not very long, we've seen a significant correction in the year-to-date period for Maruti Suzuki. Does he hold on with the hope that it will recover those levels?
It seems like, because Alex, the last 2-3 months, the stock has already gone through at least 1,000 to 1,200 point correction. So many of these auto stocks, as the interview also went by, that they're going through a softening, because of the rise in commodity prices, there could be softening of margins, and which is why the markets are, as it is, anticipating that it's likely that the prices for many of these auto stocks as well could probably correct, and they're trying to factor in beforehand as well. But what happens is, when the market prices in a correction into these auto stocks, and when the correction reaches into a particular zone where we typically call it as an oversold territory, there is a stronger case of a bounce back into the stock prices. So I think Maruti is trying to enter into the oversold territory. I think it managed to bounce back last month, if I'm not wrong, from the 6,900, 7,000 zones, managed to rally for another 200, 250 points. So it seems to be that the 7,000 mark, or slightly below that, is acting as a strong demand zone for the stock price. So keeping that in expectation, I would believe that once this a downward drift or a correction gets over, there could be a higher probability that Maruti can come back to levels of 7,600, which is the viewers cost price and go beyond that as well on the upside. So my advice would be to hold on to the stock even at current levels.
Okay, hold on the technicals. On the fundamentals, Shaina, coming to you on this one. If we're talking about the historical context, we're still way off the all-time highs for Maruti Suzuki, right? And on the fundamentals, would you therefore say that it makes a great sense to hold on to the stock for the long term?
Yeah, it is largely a portfolio stock, and if one is invested in Maruti, which is definitely not a cheap stock, one should remain invested for the longer term to make money. And if you see the service centers, they've got now a network of more than 4,000 service centers across India. So, I mean, it really gives them an edge in terms of, the demand going forward coming to Maruti. And if you see the portfolio performance in terms of their volumes, we have seen a good growth coming in their utility vehicles and exports, despite the slowdown that we are seeing in some of the smaller cars. So I would definitely hold on to Maruti for the longer term.
All right, Shahina and Kunal, that's all the time we have for our viewer queries today. So thank you so much for joining us and sharing your views and helping our viewers out as always. Meanwhile, this Friday, catch Harsh Mariwala live on Leaders of Tomorrow masterclass themed How to Become a Change Maker Through Business. All your queries on how to build a resilient business which brings about a change in the society will be answered here on 19th March at 5 p.m. Get the chance to ask live questions. Of course, we will be taking limited queries only, so please reach out to us and book your virtual seat now. LOTmasterclass.com is where you have to log in.